The financial market is a complex system. It's a dynamic and intricate web of transactions, investments, and economic activities that span the globe. Every second, countless decisions are made by individuals, corporations, and governments, all contributing to the ebb and flow of this vast financial ocean. It's like a vast, ever-changing galaxy. Just as stars and planets move in their orbits, financial instruments and assets shift in value, influenced by a myriad of factors. These factors can range from geopolitical events and technological advancements to natural disasters and human psychology. Trillions of dollars flow through this system every day. This immense flow of capital connects every corner of the world, creating a network of interdependencies. Currency exchanges, stock markets, and commodity trading floors buzz with activity, reflecting the pulse of the global economy. Investors big and small try to make sense of its movements. They search for patterns. They analyze data, study trends, and develop strategies, all in the hope of predicting the next big move. Some rely on sophisticated algorithms and artificial intelligence, while others trust their intuition and experience. They hope to unlock the secrets of making money. The allure of financial success drives innovation and competition, pushing the boundaries of what is possible. Yet for every success story, there are countless tales of failure and loss, reminding us of the inherent risks involved. For decades, one idea ruled how many people saw the market, the efficient market hypothesis. This theory predicates that financial markets are always rational and that prices at any given time reflect all available information. It suggested that it was impossible to consistently outperform the market through expert stock selection or market timing. This theory said that markets are always rational. It was a comforting thought, providing a sense of order and predictability in an otherwise chaotic environment. However, it also implied that any attempt to beat the market was futile, as all known information was already factored into asset prices. It said prices reflect all available information. This meant that any new information, whether it be a company's earnings report or a geopolitical event, would be quickly absorbed by the market, leading to an immediate adjustment in prices. The theory held that the market was an efficient processor of information. But just like our understanding of the universe has evolved, so too must our understanding of finance. The financial world is not static. It evolves with time, influenced by technological advancements, regulatory changes, and shifts in human behavior. As we learn more about the complexities of the market, our theories and models must adapt. The 2008 financial crisis showed the flaws in the old ways of thinking. It was a stark reminder that markets are not always rational and that human emotions, such as fear and greed, can drive market behavior in unpredictable ways. The crisis exposed the limitations of the efficient market hypothesis and highlighted the need for new approaches. The market didn't act rationally. It crashed. People lost money. The ripple effects were felt across the globe, leading to widespread economic hardship and a re-evaluation of financial theories. It became clear that a deeper understanding of market dynamics was necessary to prevent future crises. We needed a new perspective, a perspective that takes into account the complexities and nuances of the market, recognizing that it is influenced by a multitude of factors, both rational and irrational. This new perspective would need to be flexible and adaptive, capable of evolving with the market itself. Andrew Lowe's adaptive markets hypothesis offers this new perspective. It combines elements of traditional financial theories with insights from behavioral economics and evolutionary biology. Lowe's hypothesis suggests that markets are not always efficient, but they adapt over time as participants learn and evolve. It helps us understand the market's true nature. By viewing the market as an adaptive system, we can better appreciate the role of innovation, competition, and human behavior in shaping financial outcomes. This perspective allows for a more nuanced and realistic understanding of market dynamics. It shows us how human behavior shapes this complex system. The adaptive markets hypothesis acknowledges that market participants are not always rational and that their decisions are influenced by a range of psychological and social factors. This understanding can lead to more effective strategies for navigating the financial universe and its mysteries. The efficient market hypothesis, or EMH, shaped financial thinking for years. It said markets are efficient. It said prices reflect all information. This meant finding undervalued stocks was impossible. It meant trying to beat the market was futile. Imagine a perfectly level playing field. Everyone has the same information. No one has an edge. That's the world EMH described. But the real world is messy. People are not always rational. They have emotions. They make mistakes. The EMH struggled to explain market bubbles and crashes. It didn't account for the human element. The adaptive markets hypothesis, or AMH, offers a fresh perspective. It acknowledges the role of human behavior. It draws from fields like psychology and evolutionary biology. AMH views the market as an ecosystem. It's like a jungle, not a sterile lab. Investors are like different species. They compete for resources. They adapt to survive. This means market behavior isn't always rational. It's influenced by fear and greed. It's shaped by our evolutionary past. Understanding these factors can help us make better decisions. In the first chapter, Lowe sets the stage for his theory. He introduces the flaws of the EMH. He argues that markets aren't perfectly efficient. They are constantly adapting. Imagine a chameleon. It changes its colors to blend in. Investors do the same. They adapt their strategies to the changing market conditions. This chapter highlights the dynamic nature of the market. It emphasizes the need for adaptability. It sets the groundwork for a deeper dive into the forces that drive market behavior. Chapter 2: Our Amazing Irrational Brains. Chapter 2 delves into the heart of human behavior, examining the intricate ways our brains influence our actions and decisions. It explores the role of emotions in decision-making, highlighting how our feelings can often override logical thinking. It explains how our brains, shaped by millions of years of evolution, can sometimes lead us astray, making us act in ways that are not always in our best interest. Imagine a group of early humans living in a world full of dangers and uncertainties. They see a rustling in the bushes, a potential threat that could mean life or death. Their brains are wired to react quickly, triggering a fight or flight response almost instantaneously. They run, even if it's just the wind, because the cost of not reacting could be fatal. This fight or flight response was crucial for our ancestors' survival. helping them navigate a perilous environment. But in the modern world, especially in the stock market, this same response can lead to irrational decisions, driven by fear and panic. This chapter reminds us that we are not always rational actors, and our decisions are often influenced by deep-seated emotional responses. Our emotions can cloud our judgment, leading us to make choices that may not be in our best interest. Understanding these biases and the ways our brains work is crucial for making sound financial decisions, allowing us to navigate the complexities of the modern world with greater awareness and insight. Chapter 3: The Market Ecosystem. Chapter 3 explores the market as a complex ecosystem. It compares investors to different species competing for resources. It explains how their interactions shape the market landscape. Imagine a pride of lions hunting zebras. Lions are skilled predators, but zebras have evolved to evade them. The interaction between these species shapes their survival. Similarly, different types of investors interact in the market. Hedge funds, institutional investors, and individual traders all have their own strategies. Their interactions create the dynamic and ever-changing nature of the market environment. Chapter 4: Evolution of a Strategy. Chapter 4 delves into the evolution of investment strategies. It explains how successful strategies emerge and adapt over time. It highlights the importance of learning and innovation. Imagine a species of bird that eats insects. Over time, some birds develop longer beaks. This gives them an advantage. They can reach insects in deeper crevices. These birds are more likely to survive and reproduce. Similarly, investment strategies that work well are more likely to be replicated and refined. This constant adaptation is essential for success in the ever-changing market. Chapter 5: The Future of Finance. Chapter 5 looks ahead to the future of finance. It explores how technology and globalization are shaping the market. It emphasizes the need for continued adaptation and innovation. Imagine a world with even faster computers, artificial intelligence, and interconnected markets. This is the future of finance. It's a world full of opportunities and challenges. This chapter encourages us to embrace change. It reminds us that the only constant in the market is change itself. By understanding the forces that shape the market, we can better prepare for the future. Conclusion: Surfing the waves of change. The adaptive markets hypothesis provides a powerful framework for understanding the financial market. This hypothesis suggests that financial markets are not always efficient, but rather they evolve and adapt over time. Just like natural ecosystems, financial markets are influenced by the behaviors and interactions of their participants. This means that what works in one market environment may not work in another, and strategies must be continuously adjusted to stay relevant. It reminds us that the market is not a static entity. Instead, it is a living, breathing system that is constantly changing. The prices of stocks, bonds, and other financial instruments are influenced by a myriad of factors, including economic data, geopolitical events, and even the emotions and psychology of investors. Understanding this dynamic nature is crucial for anyone looking to succeed in the financial world. It's a dynamic, evolving system shaped by human behavior. The decisions made by millions of investors around the world create patterns and trends that can be analyzed and, to some extent, predicted. However, because human behavior is inherently unpredictable, the market can also be volatile and uncertain. This is why adaptability and flexibility are essential traits for any successful investor. Just as a surfer must adapt to the changing waves, investors must adapt to the changing market. A surfer who tries to ride every wave the same way will quickly find themselves wiped out. Similarly, an investor who sticks rigidly to a single strategy without considering the changing market conditions is likely to face significant losses. Being able to read the market, anticipate changes, and adjust strategies accordingly is key to long-term success. By understanding the forces at play, we can ride the waves of change rather than being crushed by them. This means staying informed about market trends, continuously learning and adapting, and being prepared to make quick decisions when necessary. It also means having the resilience to recover from setbacks and the foresight to capitalize on new opportunities as they arise. The key takeaway is this: adaptability is key to success in the financial market. Whether you are a seasoned investor or just starting out, the ability to adapt to changing conditions will determine your success. This involves not only adjusting your strategies, but also your mindset. Embracing change rather than fearing it can open up new possibilities and lead to greater achievements. By embracing this principle, we can navigate the complexities of the market and achieve our financial goals. The journey may be challenging, but with the right approach, it is possible to not only survive, but thrive in the ever-changing financial landscape. So let's take on the waves of change with confidence and determination, knowing that adaptability is our greatest asset.